video, we're going to be discussing another building block in accounting, the T account. We'll be covering what a T account is, how you set one up, as well as running through a simple example so you can see how they function. So with that, let's get started. The T account gets its name simply because it's shaped like the letter T. It's pretty clever, right? Anyways, there are three main components of a T account: the account name across the top, debits on the left of the T, and credits on the right. It doesn't matter whether you're dealing with an asset, liability, owner's equity, revenue, or expense account. The debits are always on your left and the credits are always on the right. A couple other terms you need to be familiar with when you're dealing with T accounts is footing and balance. Footing is the total of all transactions in either the debit or the credit column, and your balance is the difference between the footings. So for example, if you have a footed debit balance of $100 and a footed credit balance of $25, the account has a $75 balance. We simply found that by subtracting $100 on the debit side from the $25 on the credit side. So what is the purpose of a T account? A T account isn't something you're going to see in any accounting software or even in a company's set of books. It's mostly used as a teaching aid for visualization for a particular account. So let's say you have a supplies asset account with a beginning balance of $20. And this is where you've recorded all your purchase office supplies for the month. At the end of the month, you do a physical count of the supplies you have left and determine that you have $5 left in supplies. Well, we know our beginning balance, which is $20, and we know what we have left, and that's $5. So we know that we must have used $15 in supplies for the month. Since the asset accounts are decreased by a credit, we know we need to credit the supplies asset account for $15. And since our debits always need to equal our credits, we're going to debit our supplies expense account for $15. So let's take a look at a more in-depth example with a few more transactions. So let's say a company makes a cash sale for $10. Since cash is an asset and assets are increased by debits, we need to debit our cash account for $10. Since our debits always need to equal our credits, we're going to need to credit an account as well. The example says that we made a sale, and since sales is a revenue account and revenue accounts are increased by a credit, we've found the other side of our entry. So what we're going to do is we're going to enter in $10 on the credit side of our sales account. We can now see that we have a debit for $10 and a credit for $10, so our accounting equation is still in balance. Now let's pretend that the company puts gas in the company car for $5. And I know $5 isn't going to get you much gas, especially if you live in a state like California. But for purpose of these examples, I'm trying to keep the numbers small so it's easier to follow. So let's take care of our debit entry first. Since expenses are increased by a debit, and the problem tells us that we put gas in our car, we're going to need to record it in our auto expense account. We have our debit recorded, so now we need to find our credit. Since we're paying cash, that means our cash account is actually going down. Cash is an asset, and assets are decreased by credits. So we need to record that $5 on the credit side of our cash T account. For the next transaction, the company makes another cash sale, but this time for $20. Remembering back to the first part of the example, part A, we can see that we need to debit cash for $20 and credit sales for $20. Now that we've recorded our transactions, we need to foot each account to get our ending balances for each. Remember, footing the account simply means to add up the amounts on both the debit and the credit side and then find our balance. Looking at cash, we have a footed debit balance of $30 and a footed credit balance of $5. This simply means that our cash account went up by 30 and went down by 5. And when we add our debits and our credits together, our debit side is bigger than our credit side, so we can see that we have a debit balance of $25. Our auto expense account is easier because we only have one transaction, so our footing and ending balances are the same, which is a debit balance of $5. For our sales account, we have two transactions, which are both credits, so our ending balance for the account is a $30 credit balance. One thing to note is that when you have all the same transaction type in a T account like we had in our auto expense and sales accounts, your footings can serve as your ending balance. You only need to do separate footings and a balance when you have both debits and credits in the same account. So lastly, does our accounting equation still balance? Well, we have assets of $25, which is our cash account, and we have a revenue account with a credit balance of $30 and an expense account with a debit balance of $5. When we put those together, we get a credit balance of $25. And if you remember from my accounting equation video, revenue and expenses accounts fall under the owner's equity umbrella. So we have assets of $25, no liabilities, and an owner's equity balance of 25. So we're still in balance. So you're not going to see T accounts in any accounting software you use or in a company's books, but they are commonly used in your homework to help you visually see what's happening to an account balance. I still use T accounts from time to time at work when I know what I want an ending balance in an account to be, but I just can't seem to figure out how to get there. So with that, I hope you enjoyed this video. Please reach out if you have any questions. Until next time.